Hey, good morning, everybody, and welcome to this Tuesday, March 19th, 2025 edition, actually 18th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again this morning. Yesterday in the market, not really a very good day. I mean, you look at the major indices and you say, yeah, we saw a nice bounce. Did give up a little bit into the close yesterday, but overall, it's more than that to me. It's not just whether the market goes up, but it's how it goes up. It's the underlying strength of the market. And that to me was pretty weak. I've said all along that, when you go down like this, part of the valuation is how you rebound on the way back up. And so far, it hasn't looked very good. Now, we do still have a chance to continue the rally and maybe even put in a bottom. I mean, I don't think the bottom is in. But perhaps maybe the Fed has something to say. Maybe that'll change things. Very difficult to say at this point. But yeah, right now wasn't overly impressed with the rally on Monday, and I'm going to go over some of those numbers with you. Also, take a look at some of the problems that the market's been facing. I'm going to show you some charts I usually include in our weekly market report to members. We do this report every week. And so just not really looking the way I'd like to see them look, that's for sure. So let's go ahead and get started. Take a look at the action first from yesterday. I'll zero in here so we can take a look. But got the Dow Jones Industrial Average up 0.85%. Nice day. S&P 500 up 0.64%, almost 2/3 of 1%. Again, pretty nice day. NASDAQ up 0.3%. You can see the drop off as it seems like we get riskier and riskier. Although small caps really held up well, finishing up 1.1% on the small cap 600. Mid cap 400 up almost 1.5%. So really good action there. Volatility index, which was threatening 30 not too long ago, now back down close to 20. So that's kind of helped aid the market a little bit as volatility goes down. Normally we see the market go up. We still are above 20 though. What I normally, when I'm looking at the VIX and it's elevated, I normally don't start feeling better about the market until the VIX drops back down below about 16 to the downside. So right now we're still at 20.5. I think there's still a pretty decent chance that VIX picks back up again, especially if the selling really starts to kick in. We saw a little bit of that right at the end of the day. You can kind of see on this chart over here, the S&P 500. This is a 2-day chart. So you can see Friday, very nice. Moved up higher in the morning, early morning on Monday. Kind of struggled a bit into the middle of the day. And then we really had a strong rally in the afternoon. But look at that final hour coming back down, giving back a lot of those gains. You can see we were back over 5,700 right before 3 p.m. yesterday. And then we came back down and we closed 56.75. So gave up probably close to 30 points just in the last hour on the S&P 500. So that was another 0.6%. So essentially we cut our we cut our gains in half in the final hour. So again, limping into the close, not nearly as good as finishing on the high of the day. But overall, it was a pretty good day. You can see a lot of green across our major indices. So again, if you're just checking your portfolio at the end of the day, you're probably, thinking, hey, this was a pretty good day. Nice to see the market rally. If you're watching it all day like me, then you're probably not thinking quite as bullishly about the way we finished the day. One of the big problems I have is the sector strength. I mean, you saw all that green. And, we've had a lot of aggressive groups beaten up. So are we moving back into the aggressive groups with that strength yesterday? Well, you be the judge. We got real estate leading. That's a defensive group. Energy, more neutral. Consumer staples, another defensive group. Industrials, that's aggressive, but it's more the value aggressive as opposed to growth. So I would say still not exactly the group I want to see leading. I like it up in the top half of the leaderboard, but not as the leader among all the aggressive groups. And again, it's in the 4th spot. It's not like it's leading. Healthcare, another defensive group in the number 5 spot. Then we got materials, more neutral. Financials, again, like the industrials, a little bit more value-oriented part of the aggressive area of the market, if it makes any sense. Just more dividend payers, that sort of thing. And then look at the bottom four: communication services, technology, consumer discretionary. Those are your three aggressive groups. Even with a big up day, three of the four aggressive groups down at the bottom of the leaderboard. And then throw in utilities, another defensive group. But that look right there on a day of a rebound, that's weak. That's really weak. If I zero in on the technology group, look at what led last week. I said this week might have a little problem with semiconductors, and there you go. So 7 of the 8 areas of technology higher. The only one that wasn't is semiconductor. So stocks like NVIDIA, which were rolling, did have a weak day yesterday. I think NVIDIA came back in the afternoon. I don't know where it finished, actually. Let me take a look and see what NVIDIA looked like at the end of the day. Yeah, I mean, we went up through the 20-day moving average. At one point, we had a bearish engulfing candle. If we zero in here, you'll see at the low of the day. That would have been a really nasty looking bearish engulfing candle. And we did fail to hold the 20-day moving average, closing back down below it. It still finished with a dark cloud cover, if you're familiar with candlesticks. The dark cloud cover is just, I don't know, kind of a wannabe bearish engulfing candle that doesn't quite make it, where you open up just like a bearish engulfing candle would, and you come back down. But instead of totally engulfing the prior day's candle body, you only engulf about 2/3 of it, more than half. That's the key. So we finished in the lower half of the prior day's candle, which means it's a dark cloud cover. If it had finished at the low of the day, that would have been a bearish engulfing. So the way I look at these are bearish engulfing to me is a little bit more bearish, but dark cloud cover is also bearish as well. And futures this morning, let me give you those. Futures were down just a little bit, but off of that reversal from Monday, still makes me feel a little nervous. Let's see, the diamonds right now down 0.3%. The spider down 0.5%. The NASDAQ, which of course is a little bit more aggressive, down more, down 0.7%. And then you got the small cap IWM, which did the best yesterday, down close to 0.75%. So futures not doing very well. I wouldn't expect, normally things are pretty quiet the day that a Fed meeting starts. And certainly the day of the Fed meeting. Usually you see a little bit more, movement back, just less volatility, not much difference, not as much difference between your low and your high of the day, that sort of thing. I don't know if that's going to be the case this month. I think the market's very, very nervous about the Fed and what they may have to say. We got really good news on inflation I wouldn't say really good news. The PPI, which I think is the lesser of the two in terms of importance, the PPI came in well below expectations, which was great. That's inflation at the producer level. But if we look at the consumer level, the CPI, core CPI, just met estimates. So we didn't go below, but we weren't above like we had been in the prior month. So there was definitely more. I took more positivity away from it than negativity. I don't know if it's going to be enough, though, for the Fed to stop talking about inflation and to reverse course and go back to the economy. Don't know if you saw yesterday, retail sales came in below expectations, mostly due to vehicle sales. But even if you strip out vehicle sales, retail sales came in just a little bit below expectations. With the vehicle sales, we were way below expectations. I think expectations were for a rise of 0.7%, and we came in at 0.2. So just one more in a long line of not great economic reports. Then also had the Empire State Manufacturing Index. It's a survey that goes out to many of the heads of manufacturing companies in New York. And it's talking about current conditions, but really it's a questionnaire asking about where you see things 6 months from now. And the consensus estimate was that it was good, that we were expecting 0.2 is what we were looking for. Came in at -20. minus 20. That's a big miss. So, we get that. Then we had the housing market index. Wasn't that long ago, the housing market index was in the 50s up into the 60s. And we were expecting 42 in the housing market index yesterday. It came in at 39. Another big miss in the housing area. So, and if I pull up the home construction index. So home construction continues to trade down near low. It was back in October. Remember when the Fed said, hey, we're going to start cutting rates, and we did start to cut rates? Home construction index was at its all-time high at 3150, above 3150. Now the Fed is pivoted, waffled, whatever you want to call it. I like to call it waffling. But anyway, we were at 3150, and now after stopping the rate cuts and actually talking about pausing for a while and focusing more on inflation, we've seen, and of course, rates went up for a period of time. Look at this, continuing to drop all the way back from 3150 and above down to 2150 and below. That's a third of the home construction index that's dropped in about 4 or 5 months. That's a massive drop. And the interesting part is, even with rates coming back down recently, the decline hasn't stopped. So it's because I think at this point, Wall Street is betting that the Fed is not on their side yet. And I say yet, maybe hold out hope here for tomorrow policy statement, but we'll see. Look at the 10-year Treasury yield. This is basically a barometer for mortgage rates. And so you can see back in October, rates broke out. We were in a downtrend. So that kind of makes sense. Home construction is going to top when rates start going up. We topped in rates back in the second week of January. It's now the third week of March. We've gone from 4.80 on the 10-year Treasury yield down to 4.3. And at the same time, while we've been seeing this drop for over 2 months, look at what we've done. I mean, this was kind of where we were. We bounced a little bit when rates started coming down. And then while rates kept going down, we went down and set new lows. That doesn't really make any sense to me. Normally, if rates come down, or at least the 10-year Treasury yield comes down, that normally is a sign that, we're going to probably start to pick back up again in the economy. And at some point, that's going to translate into more demand for homes. And as a result, home construction index will start to go up in anticipation of all that. It's not happening right now. Continues to set new lows, even with rates coming back down. So, and the other thing is, when we look at the rates, to me, this is where I see a disconnect between the Fed and Wall Street. Fed still got its eye on inflation. Wall Street bond market has I see nothing here that looks like inflation's a problem. Not with the yields continuing to drop. That means money's rotating into bonds. You don't buy bonds with a yield of 4.3% if you think inflation's a problem. Why would you? So this just doesn't make any sense to me. So I think what Wall Street is still saying is that inflation's not a problem. The economy is. That's what the economic reports are telling us. 3 of them came out yesterday, all saying the same thing. But the Fed wants to chase inflation. Hey, and feel free to disagree. I get a lot of comments on here saying, hey, the Fed's doing their job, blah, blah, blah. If you believe the Fed's doing a great job, fine. I mean, it's just my opinion. I think the Fed has shown a history of being late to the party. No matter what they're doing, they're late. Wall Street's basically telling them, the stock market is in my opinion, it is the leading economic indicator. When I see the S&P 500 drop 10% in 3 or 4 weeks, NASDAQ down almost 13, 14%, whatever it was. The Russell 2000 went down over 17% just in the last 3 or 4 months. Those are signs to me that the stock market is anticipating economic weakness ahead. And if you need further indication, just take a look at the transportation chart. Finally, we've got a little bit of a bounce, but look at what's going on with transportation. This is highly dependent on how many goods are being shipped. That's basically it. When you look at the transportation chart. When I think transportation, I think economy. And look at where we were at the end of November when we had the rate cuts. Remember all those rate cuts the Fed was promising? They're turning their attention to the economy. They left the economy high and dry. And this is what's happened. Meanwhile, Europe continues to cut rates, and we're seeing much better market action there. So I think you got a combination of things. You got money, aggressive money here rotating toward defense. I think we're also seeing a little bit of money just purely leave the US market. And I think it's finding a home in foreign markets, which, that happens over time. We've been in a period for probably the last 10, 12 years where the US has been the place to be, and that's not going to last forever. And so this may be the start of something a little bit bigger. I'm not quite ready to give up. I just think the Fed needs to change its tune. I think we need to start fighting the weakening economy with lower interest rates. But again, we'll find out what the Fed has to say tomorrow, and we'll go from there. Let's see, what else did I have here? This isn't really, we already talked about this. Let me show you a couple charts from the report that I sent out to our members yesterday in our weekly market report. These are charts I send out every week in the weekly market report. I just think they're important enough to watch on a regular basis. So the first one here deals with sentiment. This is the equity only put call ratio. And this tracks the 5-day moving average. Now, this is just going back the last couple of years. I mean, I've traced this back for probably the last 2 decades. And what I normally see, or what I've found over the years, is that when the 5-day equity only put call ratio moves up to 0.0 or to 0.75, that is normally where you're going to see some significant bottoms come in to the market. That's where a lot of puts are being traded. And the equity only put call ratio, sentiment is a contrarian indicator. So when everybody is on one side of the trade, expect the opposite to happen. So when everybody's starting to, really jump into the puts, they're getting really fearful, and they're driving this equity only put call ratio higher. This is normally what helps us mark bottoms in the market. And so I put all these green arrows in here, showing these peaks. And then I've also put the green arrows in where the S&P 500 was at the time. And you can see many of these line up at some pretty key areas where the market takes off. And of course, right here, this was the ultimate bottom at the end of October in 2023. That was the correction that we went through. And you can see where we were above that 0.75 line at that time. Now, more recently, because we've been so complacent, look at all the options. When we look at it, all the calls that are being bought. The lower the reading, the more calls are being bought. The higher the reading, the more puts are being bought on a relative basis. And so this is just kind of like a sentiment roller coaster that we ride on. And as things really start to turn bad, we'll start seeing options traders, which, hey, there are a lot of really good options traders, really smart options traders that use them in a way to help manage risk and so forth. But there are a lot of folks that just jump into options looking to make money fast. A lot of the retail traders, they don't buy stocks. They can't make, they're investing small amounts of money. You can't really make a lot with small amounts of money in an individual stock. So they shoot for the moon and trade a lot of options. And as a result, when you get these options going too far in one direction or the other, we tend to see a reversal. And so just look at where the 5-day got to recently, just in recent months. So we got up to about 0.64 here, not 0.75, 0.64. But if you look at these extended green directional lines here, these tops right here did mark bottoms. And we just went above that. So we're starting to show just a little bit more fear in the market. And that did coincide when we went above 0.65. That did coincide with this short-term bottom. I just don't think we're far enough. I really like to see enough bearishness in the options world to get us to 0.75. In order to do that, we're probably going to have to see the market go lower. So I think we've got a chance to rally with the Fed. I think if the Fed does nothing, there's still a chance we rally just because it's a relief rally that the Fed's behind us. But if the Fed does something, says something positive, we're going to want to evaluate that move because it could be that money rotates quickly back into the aggressive area and that this most recent bottom could potentially be the bottom. If you remember back at the beginning of the year, I called for an S&P 500 correction of 10%. We got down 10.07%. We hit that correction. So it's possible that maybe we're going to rally. Now, I've been trading ETFs just for the last couple of days because I started to see some signals that suggested maybe we would get a rally. And we've seen a little bit of rally. Now I've got a pretty tight leash. Yesterday, that final hour, I was telling members in our report yesterday that I was looking for an hourly low that went below the prior hourly low before I would sell. That would trigger a sell. I just don't want to get caught in the next downdraft, if there is one. And so yesterday we didn't put in a lower low, but we definitely put in some ugliness in the final hour. And so I ended up selling half. So I've still got a little bit, but probably at the open, the way it looks like it's going to open, I'm probably just going to get out of the rest and not take any chances. And I probably won't trade again until after the Fed meeting. And I just want to see what the Fed has to say before I decide whether I want to put my money back to work. They need to change their tune about the economy. If they don't, then I think we've got more downside. And I think yesterday's action was very, very telling. I think folks they're scared to get into the aggressive groups because if the Fed keeps talking about higher rates, I think that money's going to continue to rotate either to defensive groups, more value-oriented groups in the market, or out of the U.S. market altogether and into some foreign markets or into gold. The best time to be in gold is when the VIX is elevated and when the dollar is going down. Well, we've had both. Dollar's been going down, VIX has been going up. So anytime you get that elevated VIX and you got the dollar going down, those are the ingredients for gold. And we just broke out above $3,000 an ounce for the first time in history. I'm not generally a big fan of gold, but I can't argue with what's going on in the market. The fact the market's been selling off, the VIX is elevated. I got no problems with anybody who wants to be in gold short term. Anyway, I thought this chart was pretty telling. Here's another one. So this is the QQQ versus the spider. And this is ignoring gaps. Listen, if we get a big gap down in the market, institutions can't get out on that gap down. The only way institutions can get out, the only way we're going to see real distribution is by selling during the day, not at the opening bell. Market makers take all the information coming in from all different sources, the earnings that come out, blah, 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 maybe what happened overnight in Asia, and essentially opens the market wherever, not based on distribution. It's just based on the fact that the market closes at 4 p.m. in the U.S. Eastern Standard Time, and it reopens at 9:30. And a lot of things happen between those hours. And so the market kind of is resetting based on whatever's been going on. It's not like cryptocurrency where they trade 24/7. You never really have a close. It's just continuous trading. With stocks, you got that period of time where things happen and market doesn't trade. Well, it trades after hours, but not necessarily liquid. Certainly if I'm an institution, I'm not going to try and sell 1 million shares in after hours action. Probably not going to be able to do that. So I like to follow what's going on during the day, ignoring gaps. So this is kind of a proprietary ratio that I developed, and I keep this on using the user-defined index at Stock Charts. So I have a reading every day, a ratio every day, and I post that number into my user-defined index, and then I can print a chart. And look at what's going on here. This includes gaps. So this is strictly just taking the QQQ divided by the SPY, and that's it. This actual chart's based on a user-defined index. It's based on the numbers that I put into the index. And I base this on only what happens from 9:30 a.m. to 4 p.m. has nothing to do with gaps. And so I'm seeing a lot of distribution. I mean, we're talking about a 2-year low on the more aggressive QQQ versus the more defensive spider. This is risk off, folks, not risk on. Risk on is that's what takes bull markets higher and higher. This is risk off, and it's pretty clear. I do the same thing with the XLY XLP, consumer discretionary, consumer staples. So here's your XLY XLP if you include gaps going straight down, getting a little bit of a bounce though recently. Of course, we're including the gaps. Here, if we ignore the gaps, I see no bounce. I mean, yesterday, discretionary was hit pretty hard throughout the day, and especially into the close. Staples were actually going up throughout the day, came back down. So when you look at discretionary versus staples, it was another bad day. And this thing is just going straight down. I mean, look at these. We had some support levels, and it's just gone through it like a hot knife through butter. So I think you got to be really careful here while we're looking at the market to not ignore what's taking place during the day. To me, this is just pure distribution. One more, IWM versus QQQ. This is just the small caps. Small caps have been doing a little bit better. It's still not what I would say. I'm not going to be rushing in and jumping into the IWM. But I think, Wall Street, I think, is still believing that, hey, just cut rates. Or let's get back on board of talking about cutting rates. That's what Wall Street wants to see. And then if that happens, then let's see whether it's too late. Because it might be that the economy is rolling over right now, and we may be on our way to recession. I'm not calling that, but I see a lot of weak signs in the economy. And the Fed's not helping. So anyhow, but again, these are intraday charts, again, proprietary, based on that user-defined index. But I'm looking at growth versus value. I'm looking at small caps versus large cap. I'm looking at the overall indices, QQQ versus the S&P 500. QQQ being much, much more heavily invested in areas like technology and especially semiconductors. Not so much in the value-oriented areas. In fact, financials are not even really represented in the NASDAQ 100. I think we have maybe a few stocks that have a little bit of financial connection in the NASDAQ 100, but financials are a pretty good size piece of the S&P 500. So there are differences between the two, and there's certainly a lot of differences when we start looking at the IWM versus the QQQ. First of all, it's small cap versus large cap, but IWM's got a lot of money focused in healthcare, financials, industrials, much more so than the other indices, and less in technology. So it's just a different makeup. And so that's why I like to try to figure out what's going on. It just helps to tell me a story. It helps me call the market. If you've been following us at Earnings Beats for a long time, we've made some really good calls. I mean, if there's someone out there that calls the market better than us, I don't know who it is. I think we do a really good job with our guidance. And it's from doing a lot of research over the years and then passing along that research, just like these charts I'm showing you, to our members at Earnings Beats. All right, I'm going to go ahead and wrap up, but let's take a look at Earnings Beats website, because I do want you to check us out if you haven't already. Maybe you're new to the show. If you go over to earningsbeats.com, the big thing I want to point out first is that you can sign up for a free newsletter at Earnings Beats by simply putting in your name and email address. No credit card required. You can unsubscribe at any time. I promise you, we're not going to, if you want to unsubscribe, you're not getting anything out of it, feel free. I also can tell you that we've had tens of thousands of folks who have subscribed to our Earnings Beats Digest. Obviously, there's a reason for that. We focus on the things that are really important to us: earnings gaps, relative strength. Some of these charts I'm showing you today, Sometimes, I'll have an educational chart that I put in looking at, sentiment, maybe the overall market, maybe it's divergences, individual stocks, looking at gap support, trying to find key levels, maybe individual stocks showing their relative strength, saying, hey, this is a pretty good stock relative to its peers. Been going down, but that's because its peers have been going down. Still a relatively good stock in this space. Those types of things, which I think can really help in your trading and investing. So please make sure you check this out. Go over to Earnings Beats, scroll down, and sign up for our free newsletter. The other thing, free education week. I had a couple of family emergencies here in the last 2 weeks. Both of them separate, by the way. Getting a lot of emails. Thank you all for all your support. I really mean that. It has been a couple of really difficult weeks, but it was 2 separate emergencies. It wasn't the same family member. So, yeah, it's been a rough couple of weeks, but everything's good at this point. Things are looking up much better. They say things comes in 3s. I hope this only comes in 2s. But anyway, I wanted to mention we did cancel. Well, we delayed 2 of our 4 shows from last week, free education week. We've rescheduled this for Thursday of this week. So Thursday at 5 o'clock, I'm going to do the other 2 shows back to back, essentially. So it'll probably be an hour to an hour and a half, but it's free. You can come in, look at what you want. I'm not even sure. Let's pull this up. I'm not sure what even shows here. Yeah, it hasn't been updated for the date, but it is going to be Thursday. It's going to be 5 p.m. I would go ahead and sign up if you haven't already, because that way we'll make sure we get you the room instructions and all. But you can check that out. And also just want to wrap up with, at YouTube, even if you don't want to subscribe, I mean, obviously you can subscribe to our paid service. And if you do that, you will, be on a 30-day trial. You have to give credit card information. And then we'll make you a really good deal if you want to stay on board, because monthly is very expensive, but almost all of our members are annual members because we try to give deals that cut that monthly cost in about half. And we usually will do that right before your 30-day trial expires. And again, if you don't want to keep it, that's fine. That's completely up to you. But also, if you don't want to become a member of Earnings Beats, which is fine, maybe you just like to listen to me, maybe you don't have the money for it, I completely get it. Help us by liking our video and subscribing to our channel. That will help us in the algorithm with YouTube. We're trying to build our community here. So all of our videos, make sure you like those videos and also click on the subscribe button. Anytime we do a live stream, if you're subscribed and you have your notifications turned on, you'll get a little notification, a little bell at the top of your screen on YouTube. It'll tell you when we're going live with something. So it's a great way to follow us at Earnings Beats. Make sure you're not missing anything. All right, that's it. Let's go ahead and take a quick look at the overall market. And you can see we are off to a little bit of a weak start. Got the Dow Jones down 0.25%, S&P down 0.4, NASDAQ down 0.75, small caps down a little more than half. So similar to what we looked at, before the market opened, the futures. I'm just thinking we're probably just going to meander here going into the Fed meeting. Maybe the market will start to anticipate that the Fed's going to have something good to say, but I don't know. The distrust there right now makes me think that's probably not going to be the case. We are oversold, so maybe, options expire this Friday. That's another reason. We didn't talk about that today. That's another reason why we could see the market rally, because we've had so many folks playing puts. Anybody who's bought puts on the way down recently is in the money. Anybody who's been buying calls have seen that money evaporate. So you got a lot of in the money puts, and anybody who's been buying calls is going to be down here because all of that's, you've been losing value as the market's been dropping. So maybe we get a little bit of a bounce to wipe out some of the put premium and to increase some of the call premium to kind of offset one another. Typically what we see going into option expiration week is a market that's been going up and comes down like last month. This month, not the case. This month, obviously, we've been going down. So now we have an opposite effect. We may see the market rally into options expiration. So That's another reason why potentially short term we could see a little bit of a rally. Quite honestly, unless the Fed gives me a nugget of hope that they're thinking about cutting rates, I personally want to stay the heck out of the market. So anyhow, that's it for me today. I appreciate everybody tuning in. Again, make sure you like the video, hit that subscribe button, be notified anytime we do our next or any of our live streams. So have a great day, everybody, and hopefully see you next week. Happy trading.